Everyone is concerned about the economy. We wonder what changes we will see next and what the results of those changes will be. With talks of recession on the horizon, an understanding of the economic cycle and where we are on that cycle can help put things into perspective. That is where billionaire investor Ray Dalio comes in. He has done extensive research on market cycles and has some valuable lessons to share. Welcome to The Eighth Wonder, a channel dedicated to making compound interest your best interest. Ray Dalio is known not only for founding and managing the most successful hedge fund in Bridgewater Associates, but also for his ability to explain in detail and simplicity some of the most complex concepts that govern the economy. He recently had a bit to share in an interview he did explaining where we are in the economic cycle.
I mean, these things happen over and over again. We're now in the 12th and a half cycle. You know, these cycles, you know how the cycles work. You're 12 and a half cycles since 1945. 1945 was the New World Order, you know, new monetary system. And you know what happens. So let me take you through it quickly. You get a funky economy, weakness, and so on. So what we had, of course, in 2020 with a combination of COVID, and then also the move from the right to the left. There was a distribution of wealth. And so how did you do that? The government had to send out a bunch of checks.
Yep.
And the Federal Reserve, where did the government get the money from? The Federal Reserve lent it. So we have an imbalance. And, of course, that put a lot of money in the system. You've got the demand. You've got the cycle, classic cycle, right? Stimulation, credit becomes debt. Then you have inflation. Then you have a tightness of monetary policy.
He starts off talking about how we are in the 12th and a half cycle. What he's referring to is explained in a video he made titled How the Economic Machine Works, which I've linked in the description. Basically, these are debt cycles, short-term and long-term. The short-term cycles make up the long-term cycles. So Ray here is talking about how the current short-term cycle, which as he explained was caused by the loose monetary policy that came as a solution to the negative impact of COVID on the markets. Interest rates were lowered. Government started printing money and giving it to the people in the form of stimulus checks, and all this was done in order to stimulate the economy, but also resulted in demand exceeding supply, which in turn caused inflation to rise. And with the low interest rates, a lot of lending was done. In response to the high rate of inflation, the interest rates were increased, and stimulus checks were slowly phased out. This is what he means by tightening of monetary policy. He also makes mention of the New World Order that started in 1945, which was when the US dollar became the reserve currency, the currency that the global economy trades on, which is why you always hear of prices of things sold like commodities in US dollars. Whatever happens to the US dollar affects the rest of the world, which is what inspired the saying, when America sneezes, the rest of the world catches the cold. This also explains why the US housing market crash in 2008 had such huge effects on the global economy.
And so where are we? So we now in a classic spot where we've got a relatively high real interest rate. Real interest rates went from minus 175 basis points to plus 175 basis points, right? You've got a cash rate that's relatively high. Cash used to be trashy. Cash is pretty attractive now. You've got an inverted yield curve.
Say that again. You said trash is now more attractive?
Cash
is trash, is what you used to say.
Yes, cash was negative,
right?
1.5%, 2% real rates, terrible. Now cash is relatively attractive.
Right.
So it's attractive in relation to bonds. It's actually attractive in relation to stocks. You have the classic movement, of course, as rates go up and money becomes tight. You lose the parts of the economy, the parts of the market that are the bubble parts that needed the cash flow, right?
Right.
So you're seeing it reflected in not only, long duration stocks, those that didn't have cash. So you see the tech stocks come down, all of that come down. You see private equity, you see venture capital because they needed cash. All of that comes down. And then, so you're seeing a very, 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 very classic that we've seen these things for 12, halfway through a 12 or 13th cycle, right?
Some interesting thoughts there from Ray. He came out in 2020 when interest rates were down to zero, saying that cash was trash. And now with the interest rates having picked up, he now says that cash is relatively attractive in comparison to stocks and bonds. This is, however, in the short term. He also talks about how some companies didn't have cash flow and therefore needed cash, and this was a big reason why Silicon Valley Bank fell. It served a lot of these venture-backed businesses that had a lot of money in the bank, amounting to total assets worth $210 billion, which Silicon Valley took about $91 billion of and invested most of it in 4-year low-yield bonds. When interest rates rose, the returns on the bonds became inferior, and when the companies came looking for their money, the bank had to end up selling those bonds for a loss. This triggered much fear for the rest of its clients, who in turn thought it a good idea to pull their money out in an attempt to save it. But since banks operate on fractional reserves, they couldn't give everyone their money, and that caused the bank to fail. A lot of companies also saw their share prices drop, especially tech stocks. As he explained, the money policy got tighter, spending and investing slowed down, which caused the markets to cool down.
But what's also happening in that cycle, since 1945, is that we then have the accumulation of a lot of debt and money. Okay, so we deal with things like the debt ceiling. Does the debt ceiling matter? Does it matter how much debt we have? And then you have a situation where there's used to be a free market supply-demand, but now you've got the Federal Reserve who is now taking it, buying it on the balance sheet, so it's not the supply-demand. So you've got that dynamic very, very classically going. I don't think people are paying enough attention to the big cycle. There are these short-term cycles. Since World War II, they've averaged about 6 or 7 years, plus or minus about 3 years. That's what we're in a classic one of those. But we keep building up the debt. And then there are issues in terms of the issue of the dollar and what's happening in terms of the world and the value of money.
So now Ray talks about how these short-term debt cycles play into the long-term debt cycle. As we keep borrowing to cover certain needs, the debt builds up until it finally comes due. He made mention of the debt ceiling. So now Ray talks about how these short-term cycles play into the long-term debt cycle. As we keep borrowing to cover certain needs, the debt builds up until it finally comes due. He made mention of the debt ceiling. This refers to the cap that is placed on national debt. This debt has gone up significantly and is the same debt he was referring to when talking about the money that had to be borrowed in order to stimulate the economy. The debt ceiling is set by the US Congress through legislation to accommodate the government's borrowing needs, and when it is reached, the Treasury Department may take extraordinary measures such as suspending or limiting certain government payments to avoid defaulting on its obligations. The US Congress can, however, raise the ceiling if the US government is unable to reach its financial obligations. This would mean suspending the debt ceiling to allow Treasury Department to continue borrowing money. This would require passing legislation on both the House of Representatives and the Senate, and then being signed into law by the President. If the debt ceiling is not raised and the US government ends up unable to meet its financial obligations, the result would be a default in US Treasury securities, which would have a severe consequence on the US economy and global financial markets. A default in US Treasury securities could lead to increased borrowing costs for the government, reduced confidence in the US financial system, and potentially a global financial crisis. With how severe the economic conditions have been, chances are the debt ceiling will have to be raised. He also talks about the effect of the government on the markets, saying that it is not a free market anymore due to the US Federal Reserve being of great influence, so it's not just demand and supply. We have seen how they've controlled the monetary policy, which in turn has a major influence on demand and supply. So what is Ray Dalio seeing in the near future?
You can see which stocks are going down, right? You see the tech stocks, you see real estate going down. Residential real estate goes down, and we're having something close to let's say a stagflation, meaning maybe 3.5. I think you're going to see inflation come down to this, and then because of the way it's calculated, it'll go up a bit. And so you see that kind of an environment with something close to maybe a 1% growth rate.
Right. According to Ray, we'll most likely enter into a stagflation, which is an economic condition characterized by a combination of stagnant economic growth, high unemployment, and inflation. It is a rare phenomenon that challenges traditional economic theories, as inflation and unemployment are generally expected to move in opposite directions, with inflation rising during periods of economic expansion and unemployment falling, and vice versa. Stagflation can create a challenging economic environment with potential negative impacts on business, consumers, and governments. This would mean further downturns in the economy that can take a while before easing up. So what about recession?
This type of recession is not a bad recession. It's a lot less bad than I thought it would be because of the fact of how it's distributing and shrinking that credit. At the same time, though, we have a real issue for the United States debt in the world because we're selling all this debt. You know, if you look at wealth instead of GDP, wealth is a much better indicator of things. GDP is like looking at revenue. How much did you sell? We have borrowed a lot of money, okay? And now we're having a problem selling that money around the world.
Right.
And it's also happening that this political situation, geopolitical situation, is weakening the demand for U.S. bonds.
So a recession, as many predict, is inevitable. Some may argue that it is already here since what counts as recession isn't so clear anymore. Ray Dalio says that it's not as bad as he thought it would be and that it's actually helping in shrinking credit. He also talks about how the decreased demand for U.S. bonds can have a negative impact on the U.S. dollar.
The biggest issue is that there's more spending, and I would say there probably needs to be more spending than we have income. And that's a problem, right? Governments run the same as your household or a business in that, with two exceptions. They can print money and they can tax, right? So then when you spend more than you earn, the question is, and they're going to spend more than they're going to earn, where are you going to get the money from? Are you going to get it from taxes? And if you get it from taxes, people fight because they don't want to give up their money. Or are you going to get it from printing the money? And so how do you achieve that balance? Because do you spend less?
Right.
Well, it's a tough environment to spend less. You have to spend more on defense. You have to spend more on rebuilding. The Green Initiative is expensive. I mean, education is expensive and so on. So there's a dilemma that she is sitting in, that we as a country are sitting in. So, how do you solve that problem? I think that, if you were to, let's say, take the bigger picture, there's a lot of things that you can invest in that will produce returns. And I think, for example, I don't think we invest nearly as much in the basic things like great education and making sure that certain areas do not have conditions that are substandard conditions. And so to invest in those things that are going to produce productivity. Education's a good thing. Infrastructure's a good thing.
So the biggest problem, Ray states, is spending more than what we earn. This is a problem for individuals, businesses, and governments alike. The solution he gives is investing in improvement and growth. Investing in better education, to me, is a big one. Sometimes, that investment can come in the form of spending time learning from videos like this, which I aim to educate. So do subscribe if you found this video to be educational. The only way of preventing similar mistakes from happening is to learn and prepare, which is essentially what Ray Dalio is suggesting here. So we should invest in ourselves by getting educated. But what does Ray Dalio think of investing in the markets in the current conditions?
I think the markets as a whole, they were obviously, I would say, the interest rate changes were obviously had to come. The impact on the other markets had to come. They have come. They have been into the price. So now you're going to have probably a tightening or a tighter monetary policy than existed, and that's a net negative for the stock market, but not in such a big number that it's like a big bearish thing. So when I look at the market as a whole, I would say, okay, well, now it seems closer to fairly priced, probably still a bit high, given that whole picture.
So the markets were overpriced and are now getting closer to being fairly priced. This does not mean that you should try and time the markets, but this could be a good entry point depending on what you're looking for. So there you have it. Ray Dalio sees some downturns still to come, but eventually as the economic cycle works, there will be a time of growth again. Keep on going, but do so cautiously. I've linked 2 videos from Ray Dalio in the description: how the economic machine works and principles for dealing with the changing world order. These will help explain some of the concepts taught in this video in greater detail, so do check them out. Let me know what your biggest takeaway from this video has been in the comment section below, and what else you'd like to learn about. I hope that you found value in this video. If you did, please do indicate it by leaving a like and sharing the video with a friend. Subscribe to the channel if you haven't done so already, and make sure to click on the notification bell so you never miss an upload. Thanks for watching. Hope to see you on the next one. But until then, stay invested.